In this video, we're going to take a look at a couple of relatively new options-based ETFs that claim to offer a targeted 20% dividend yield. And additionally, both ETFs pay distributions monthly to shareholders, which undoubtedly makes them more appealing to income investors. The two ETFs we'll be examining today are the Defiance S&P 500 Target Income ETF, ticker SPYT, and the Defiance Nasdaq 100 Income Target ETF, ticker QQQT. Both of these funds were launched by the company Defiance, who also offers several other types of options-based high dividend-paying ETFs. Both are practically the same, with the only difference being what index they use their strategy on. We'll look at SPYT first, which is the first one they introduced. According to this fund's page, it says, the aim is to achieve a targeted annual income of 20% in the S&P 500 using options paid out monthly. SPYT is an actively managed ETF dedicated to generating current income. Our strategy revolves around holding shares of ETFs that track the S&P 500's performance and engaging in the selling of daily credit call spreads on the index. Our option strategy involves selling a call option while simultaneously buying another call option at a higher strike price. By focusing on short-term options, we aim to offer an enhanced yield compared to traditional options-based strategies. SPYT's investment approach is meticulously designed to generate income through option premiums derived from selling index call spreads, the primary driver of the fund's yield. We sell at-the-money or near-the-money call spreads to retain upside growth potential and aim for a target annual income level of 20%. The fund page for QQQT is the exact same, so we'll focus the majority on SPYT for this. I've been observing this ETF for a while, and I wanted some time to pass before covering it in depth so I could observe its performance and see if it lives up to its goal. Because when I first saw Defiance was the company behind these funds, I was skeptical. They're the same company behind QQQY and two other zero-data expiration ETFs. These funds tout some really impressive dividend yields and they attract a lot of income-focused investors, but it comes with a massive trade-off, which is share price declines. These funds like QQQY are among the worst when it comes to living off dividends if that's your goal. If you don't want to lose your money, let alone grow your money, you have to keep reinvesting all the dividends. When you do that, these ETFs can be profitable investments, but it defeats the purpose, in my opinion, of offering a high yield. But the good news is that both SPYT and QQQT use option strategies that are far superior, depending on what you're trying to achieve. Let's start by understanding how these ETFs work and how their dividends are generated. In its prospectus, it says, the fund strategy involves holding shares of unaffiliated passively managed ETFs that seek to track the performance of the index. In other words, this ETF will only hold an S&P 500 index fund. Looking at its holdings, we can see it does in fact only have one holding, which is the iShares Core S&P 500 ETF, ticker IVV. Continuing on, it then sells daily credit call spreads on the index. The fund's daily credit call spread strategy consists of selling a call option and simultaneously buying another call option at a higher strike price for income generation. The fund's investment approach is designed to generate income through option premiums derived from selling index call spreads, which will be the primary driver of the fund's yield. To retain upside growth potential if the value of the index increases and seeks a targeted income level of 20%, the annual target, the fund sells at-the-money or near-the-money call spreads. The sold call spreads generate premium and also allow the fund to benefit if the index's value increases above the call spread's cap via its index ETFs holdings. So this is basically what you need to know. This makes it quite a bit different from other covered call funds that you're used to seeing. What you need to know is that upside in share price for this fund and QQQT is going to be significantly more capped than other CC funds. That would include other ETFs like the NEOS S&P 500 ETF, SPYI, and XYLD, the Global X S&P 500 covered call fund. What you're looking at is a side-by-side comparison of all of them over the past 6 months, and you can see that SPYT has the least amount of upside when the S&P 500 is rising. This kind of option strategy is typically used when a trader is betting that an asset will have a limited increase in share price. The strategy uses two call options to create a range consisting of a lower strike price and an upper strike price. The call spread also limits the maximum loss of owning an asset to the net cost of the strategy. As a result, there's less volatility when using this strategy, which we clearly just saw earlier. An ETF like SPYT or QQQT can be great investments if you think the market is going to be flat for an extended period. But of course, in a bull market, it still performs very well. In fact, if we look at the total performance of this ETF from a share price perspective, it's only down 2.86% since it first launched. The S&P 500 is down a bit over the past month, and then of course it's still offering that 20% dividend yield, which is where the vast majority of the returns are going to come from with this ETF. From a total return perspective, including reinvested dividends, SPYT has delivered a 13.85% total return over the last 10 months. Of course, one thing that absolutely needs to be addressed is that because the share price is capped much more than traditional covered call funds, this is not something that you should expect growth from. It should also be mentioned that the dividends these ETFs pay aren't labeled as qualified if you're a more tax-conscious investor. When the share price falls on these funds, then you can also expect the dividend amounts to also go down. That's just the nature with most of these derivative ETFs. When these funds advertise a 20% dividend yield, that's 20% of the current share price. So if the share price of these funds trend downward over time, they'll still provide a 20% yield, but the dividend payments are going to go down with the share price. If we look at the dividend distribution history for SPYT, you can see they've been very steady along with its share price. They're never the exact same each month, but the amounts are usually different by only about a penny or less each month. And the exact same situation is going on with QQQT. So with all things considered, which of these two funds would be the best pick? Given how the S&P 500 is much less volatile than the Nasdaq 100, I would have to go with SPYT as the superior choice. Since the Nasdaq has gone through more serious declines in share prices than the S&P, this should make SPYT a safer holding. And if both funds are offering the exact same 20% yield that's fixed, there really isn't a great reason for holding QQQT unless you wanted to diversify by holding both funds. Now, it's possible QQQT could see slightly more growth, but bear markets are going to hurt significantly more for shareholders of this ETF whenever that does happen someday with tech. The Nasdaq 100 is overwhelmingly tech-focused, whereas the S&P 500 is more balanced in terms of what sectors it holds. IVV, the index fund inside of SPYT, is 33% tech compared to 52% of the Nasdaq. It also holds higher amounts of other sectors, including financials, cyclicals, and healthcare. Let's also talk about something that I'm sure is on a lot of people's minds. Given how these two ETFs offer a high yield and more share price stability, some are probably thinking that SPYT or QQQT would make for better alternatives to a high-yield savings account. Besides the obvious facts, like SPYT isn't FDIC insured, there's a couple things that I'd suggest people think about if that's what you are considering. Ever since both of these ETFs launched, we've been in a pretty good bull market, and we don't yet know the full extent of how they'll do when we go through another correction. Although these ETFs attempt to remain flat with their share prices, there's still periods where they can be down. That's why I'd be hesitant to look at these two funds as something like a savings account. But other than what we've looked at already, what else is there to consider? A 20% dividend yield paid monthly is better than most high-yielding ETFs. Sure, there isn't much share price growth, but that 20% yield is still excellent. Why not just sell everything or almost everything else and only hold these funds, especially if you're the kind of investor that's not worried about share price growth? What concerns me the most about both of these ETFs is just how significant their share prices have underperformed their index. In the case of SPYT, this ETF launched on March 7, 2024, and again the share price of SPYT is down 2.86% since that launch date. If we look at the S&P 500 since March 7th of last year, this index has exploded 14.34%. That's significantly more than a typical year's performance for the S&P, and yet SPYT is still down after all those massive gains. My concern is that in the event of a stock market correction, which is defined as the market falling between 10 and 20% from its highs, then these two ETFs could get wrecked. If there's a significant bear market, which is 20% or greater in terms of losses, then both of their share prices might take many years to recover. That's the biggest risk people need to keep in mind if you're considering either of these funds. Ultimately, I can see both of these ETFs as being something worth considering in a bull or a flat market, but they're also the kind of holdings that I'd be tempted to bail out of in a bear market. It's why I still prefer SPYI for my S&P 500 covered call fund. This ETF has provided better growth in share price and dividends since its inception. Despite its lower yield, it's better designed to withstand bear markets and it has better dividend tax treatment. Let me know your thoughts in the comments and if you think these ETFs are worth considering. But with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.